Okay, you guys, we're now going to look at problem 3-1A on page 139 in your textbook. Hope you've already watched the Chapter 3 lecture videos and worked through those examples with me. If so, these should be fairly simple. If you haven't, go back and watch those first and work through those examples with me before coming to this one. Okay, and if I were you, I'd try probably doing this problem 3-1A on the journal template before I watch the video, and then you could kind of check it by the video if you want, because if you've already gone through those examples in the lecture, this should be fairly simple, I think. Alright, let's read through it. On March 31st, 2016, the following data were accumulated to assist the accountant in preparing the adjusting entries for Potomac Realty. Alright, so let's read A. This entry will be dated March 31st. All your adjusting entries, of course, are dated the last day of the business's fiscal or business year. Okay, it says the supplies account balance on March 31st is $5,620. That's the amount from the unadjusted trial balance, or from the ledger, before adjustment. And supplies on hand at March 31st are $1,290. That's the amount from our supplies inventory count. Okay, now the amount from the ledger or unadjusted trial balance is the balance to begin the year plus all of our purchases during the year. What we know, though, is some supplies were used during the year, because at the end of the year we only have $1,290 worth of supplies left. So supplies used, their cost is no longer an asset, it has now become an expense. So we want to debit that to supplies expense to increase the balance of the expense account for the cost of supplies used during the year. That's going to be $5,620. The balance on the unadjusted trial balance minus the amount of supplies from our inventory count that are left at year end. So that's $4,330. Or now, the asset account supplies is going to decrease by the same amount. If the supplies have already been used, their cost is no longer an asset. It's now instead an expense, and that's going to be 43. Let's put our number in again just to check it. 5620 minus 1290, 4330 again. Okay, so what we did there, we increased the expense account supplies expense with a debit for the cost of supplies used during the year, and we decreased the asset account supplies for the cost of supplies used during the year. Okay, let's go to B. The unearned rent account balance on March 31st is $5,000, representing the receipt of an advance payment on March 1st of 4 months' rent from tenants. Okay, on March 1st, that entire $5,000 was unearned rent. But by March 31st, we've earned 1 month's worth, or a quarter of it, right? So our unearned rent has now decreased. Since we've earned a portion of the rent, unearned rent has decreased to liability. They decrease on the debit side. Well, we want to make this entry for the amount of rent earned from the day the payment was received to the end of the fiscal year. So it will be the amount of rent earned from March 1st to March 31st. That's 1 month's worth. Well, if it's $5,000 for 4 months, we'll divide 5,000 by 4 and get $1,250 for 1 month. So we want to decrease unearned rent, the liability, by the amount of rent earned from the day the payment was received to the end of the year. It's $1,250, 1 month's worth. Okay, now we want to increase the revenue account, rent revenue, with the credit. Revenues increase on the credit side by the amount of rent earned from the day the payment was received to the end of the year. Again, $1,250. You guys, if that payment had been received on February 1st and no adjusting entry had been made, we'd have to make this for $2,500 because we would have then earned half of it by the end of the year. Hope that makes sense. Alright, then on C, wages accrued but not paid at March 31st are $2,290. Accrued just means built up. So wages that our employees have worked for and earned, but they haven't been paid yet on March 31st. What's happened here? Let's say our employees worked the last few days of the month, maybe the last couple days of the month of March, but they're not going to get paid for that work until sometime in April. But when did their work help us to earn more revenues? Well, if they worked in March, they helped us to earn more revenues in March. So we want that expense on the books in the same period as the revenue it helped us to earn. So we want to show wages expense for March of $2,290 in addition to what's already been recorded. Because the employees worked in the month of March, even though they're not going to get paid until April, we want the expense to show up on the income statement for March, and that gets it on the books. Now normally if we had paid them, we'd credit cash. Here though, we're not going to pay them until sometime in the next year, or the next fiscal year. It'll actually be in the month of April. So instead of crediting cash, we're going to set up a liability account, wages payable. We have a liability there to our employees. Even if we don't operate in the new year, we still have to pay them for work they've already performed in year one. So what we did there, we increased an expense account with the debit, wages expense because the employees worked in the month of March. We want the expense recorded in the month of March. We haven't paid them yet, but we're obligated to pay them. So we set up a liability account, wages payable. It increased. Liabilities increase on credit, and our expense account here increased on the debit side, as they do. Alright, then on D, fees accrued but unbilled at March 31st are $16,825. Well, here, it's a similar situation to C, except this one's on the revenue side. What's happened, we provided service to customers the last few days of the month of March, but we're not going to bill for that until sometime in April, and not get paid until sometime in April or May even. But if we provided the service in March, then we earned the revenue in March. So we want to go ahead and increase the balance of accounts receivable, because these customers are going to owe us that amount even if we don't operate in the new year. We've already provided them with the service. So we'll increase the asset accounts receivable with a debit for $16,825. And we're going to increase the balance of the revenue account, fees earned, by $16,825. We now earn more revenue for the year. That revenue was earned in March, so we want it to show up on the financial statements for March. Okay, and then depreciation of office equipment is $4,600. Right there, we'll increase the balance of our expense account, depreciation expense. Expenses increase on the debit side. And we also want to increase the balance of the contra asset account, accumulated depreciation. Contra assets increase on the credit side. Alright, you guys, after watching this one, you should have no problem with your, or no trouble with your homework problem. Problem 3-1B. And again, be sure you go through the Chapter 3 lecture and the example journal entries before trying any of these. If you have questions or concerns, please be in touch with me. Thanks a lot.